What is going on? Welcome to my channel. I am the covered call guy. On this YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 covered call ETFs. If you want to know what it is, stay tuned. At the end of every month, I do a portfolio review of my holding size, what I'm holding, what I'm buying, selling, and cash on hand. I do a review at the end of every month. Stay tuned for that. My annual dividend income currently is $70,000, 5.8K a month, 1.3K a week, $191 per day, $7.99 per hour, give or take. Estimates. These are my projected. All right, legal disclaimer before we start though. This content for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong, so please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember guys, I am just some random idiot you found on YouTube and I could be completely wrong. Now with that out the way, today's video is going to be kind of like I got this idea of a follow-up on my recent exit from Roundhill. So I'm going to ask myself and ask you guys, is this the great ETF rug pull? I'm going to talk about the good, the bad, the ugly of it all, right? Asking myself and asking you, are your high yield funds secretly bleeding your cash? All right, we're going to break down the institutional data that was given, completely unbiased. I'm not saying it, I'm not making it just because I've exited the Roundhill position, but this just gave me an idea of looking at deeper, right? All right, so my core thesis is that I'm tracking the historical surge in synthetic income ETFs, but a massive divergence is hiding beneath the surface. What I mean, core thesis here is that we need to look for the good, the bad, the ugly, despite record industry inflows, right? My previous video just talked about that. Early 2026 data does show single stock and 0-day time expiration funds from YieldMax and Roundhill are suffering highly concentrated capital outflows, okay? All right, so let's look at the macro baseline. This is the good, right? So we had about 156 billion net inflows of January 2026. Extremely good. Why? This is record industry inflows, right? This is the good news. So this is the option income space is thriving, okay? Investors' appetite is huge, right? You and I, right? The US ETF pulled an estimated $156 billion in January alone. This is the strongest start in ETF history. So this means that overall the strategy of generating yield, right, is widely accepted and growing. All right, let's look at the synthetic income boom. All right, 5.6 billion. The derivative income category raked in a record 5.6 billion in January 2026, 58 months. Right, so this category has notched net inflows in 58 consecutive months since March 2020. So overall, 167 billion in synthetic income channel has reached an incredible pretty much assets under management of 167 billion. So this is good. This is great stuff. All right, so before I start, this is my assessment and this is my confirmation. This is my take on it, right? So of course, let's get this out the way. Capital is not leaving the options income space, right? So the continuous acceleration of inflows proves that any fund bleeding capital right now is more, I believe, facing a structural rejection, not a macro trend. All right, so first, flow divergence. This is the winners, right? Institutional beneficiaries such as mainstream money is rewarding established broad index managers. The biggest one would be JPMorgan from JEPQ, right? Absorbed the massive 522 million in a single week. So total assets for JEPQ and JEPI continue to completely dominate the segment's market share. This smart money, everybody's piling into smart money, right? NEO's fund, they're so good at securing capital. Looking at their NEO's QQQI year-to-date inflows of plus 1.72 billion, right? Elevating its asset base to a massive 8.82 billion by late February 2026. With their NEO's SPYI year-to-date flows 1.14 billion, right? Pushing total assets for this S&P 500 equivalent to about almost $8 billion, right? So these two, JPMorgan and NEO's, has been completely dominating. Let's look at the bleed. YieldMax ULTY, right? Losing about 5.6 assets under management, right? This is the good and the bad. Let's talk about the good, right? I'm not going to this is not a trash video. I'll talk about it all, right? The good is that YieldMax does offer a massive target yield and innovative exposure, but that's if you want pure cash flow, right? They deliver that. The bad, however, is that capital is actively withdrawing, right? This is the Ultra Options Income Strategy ETF ULTY experienced a 1 month net outflow of 58 million, right? A 5.6 decline. This is already showing the first crack of 2026. Let's look at the bleed accelerating from YMAX, right? A negative 8.9 assets under management loss, right? This is a very severe contraction, right? So we have to look, and we must look at these percentage to see real damage. YieldMax Universe Fund YMAX shed 40 million in a single 5-day stretch, right? This is a severe contraction of 8.9% of its entire $448 million assets under management. This could actually create real panic, right? A lot of outflows. All right, let's look at Roundhill. All right, I'm looking at from a balanced view, of course, because WPAY has lost 15% of their assets under management, right? I want to talk about the good and the ugly. I'm not just talking about it because I completely exited my position, but I just want to give a whole point of POV, right? So looking at the good, Roundhill is highly diversified, right? That means they're non-income funds like MAGs with a 3.5 billion and Chat with 1 billion are doing incredibly well. However, the ugly part of it, so within their income focused, right, localized redemption are very evident. Looking at just WPAY, recorded a negative $28 million outflow, right? Very highly concentrated, 15% capital flight. All right, you're gonna ask, show me the receipts. Well, you want it. This is where I got it from, right? So if you want actual data to prove these numbers, let's do the math together based on year-to-date 2026 ETF action and Morningstar flow data. So if they're wrong, I'm wrong. All right. So if they're right, I'm right. But this is just the basic math behind it. Looking at this, right? YieldMax total assets under management, right? We're talking about year-to-date 9.33, year-to-date outflow negative $553 million. Look at the math here. I've divided 5.9. That's why I got my math. Roundhill, right? Total assets under management 9.45, year-to-date outflow of negative 661 million, right? And look at the category here, right? Overall category of this type of derivative income field, starting assets under management 161, January inflow of 5.6 billion. So while they're losing outflows, others are gaining the inflows. It should start saying something to you, right? Is it the management issue? Is it a structural issue? Or they just have terrible strategy? What is it, right? Or is it just the market conditions? Obviously, if the underlyings are doing poor, people just have glass hands and they just exit, right? They don't have the diamonds hands and they just leave it. So it could be a whole bunch of reasons. I talked about my reasons. Other people have their reasons. All right. This is from market share drift. Because these specific issuers are shedding 6 to 15% of their income-focused assets, while the broader category expands by about 3.5%, the market share delta is materially negative, right? So this is a definite structural signal. Looking at diagnostic ones, right? The good, the bad, and ugly. Let's look at the good. Retail capital is initially flooded, YieldMax products for an amazing reason. Marketed distribution yields often exceeding 50 to 100%. The bad and ugly, well, they welcomed you to the yield illusion and total return drag. That's the first time they are starting to see, hey, this might not actually be good. Given in a full year and a half, is not working. All right, let's look at the asymmetric trap, right? The good and bad. All right, the good is that it has massive immediate income. The bad, however, strictly capped upside, right? You did miss the massive tech rallies. Investors see funds like TSLY generating negative total returns, while Tesla, if you bought it, has actually appreciated, right? The ugly, 100% exposed downside, right? Investors has watched Coney suffer principal erosion despite underlying crypto rallies. Okay, massive nominal distribution rates do not offset principal decay. This is the illusion. All right, the devastating math has that 11.2 annualized loss here, right? This is the true cost, right? Looking at independent dollar weighted return analysis, estimated the average dollar invested in YieldMax ETF lost about 11% per year. Looking at a whole, right? So this is based on data from December 2022 through mid 2025, having almost a 3-year time frame historical data, right? Assuming, of course, you reinvest 80%. Okay, this is a persistent drag, right? This is actual reality that you're looking at. This is what I'm talking about in my other videos when I'm talking about drag. You have to look at the drag here. Right, diagnosis 2 is the ugly truth of NAV, right? Return of capital. A lot of people that don't know about it talk bad about it. People who know what return of capital is and know actual benefits behind it, right? Tax accounting purposes, know it's actually good. Of course, there's good and bad, right? So while options fail to generate significant premium, managers are mathematically forced to dilute to liquidate your rock, right? So this is not yield. This is the bad. There's no defending it, right? It's a systematic return of your own capital while destroying your principal, okay? So if the NAV is distributed and the NAV naturally shrinks, this is decay, cannibalization. All right, the ugly details. Looking at the rock receipts, right? YieldMax Misty declared February 2026 distribution composed of 100% return on capital. Same with YieldMax APLY, right? Reported 79.91 return of rock. Roundhill XDTE and RDTE, right? Zero date funds explicitly note that estimate distribution consists of 100% rock. This is your awakening, right? Tolerance for paying management fees to essentially receive your own principal back is diminishing rapidly. This is evidence. This is actual evidence of whether you're trying to hold this or not, whether you have to make the same decisions I had to make and exit. Okay, if you're holding this, this is, your own principle. This is your money. At the end of the day, you might have to come to the same conclusion that I made. So, yeah, look at it. Is it good? Is it bad? That's on you. All right, diagnosis 3 is the frictional cost. Looking at the expense ratio, obviously, NEOS is performing so well with a lower expense ratio, giving you a lesser fee drag. So they don't have to perform as great because they don't take too much from you. So the expectation for you is, okay, at least just give me a little bit slightly better than what you're taking away from me. While the others really, they can only perform so well in certain market conditions. All right, liquidity and hidden taxes. I talk about this a lot, like talking about the wide spreads, right? So heavy trading in single stock or weekly pay options introduce these wide spreads. Basically, you are forced to absorb hidden liquidity costs upon entry and exit. The preference here, looking at the flow data, indicates you are abandoning higher fees, right, for broad index strategies. So a lot of people are getting away from these single stock the higher fee wrappers for more broad index based SPYI, QQI, GPIX, GPIQ. Basically, for the most part, my 6 holdings. All right, strategic outlook. I think this is just my opinion here, okay? If the broader macroeconomics environment were experiencing a risk-off rotation away from yield, then the entire derivative income category would be suffering redemptions. But this is not a total collapse. It represents a competitive displacement, all right? That is my conclusion. That is my strategic outlook. Remember, if you didn't watch the video that I put out for my February portfolio, this is my competitive displacement. I'm just saying, Roundhill, there are better options, better issuers. I'm just going to put my money into NEOS, okay? Market implications. So if this persists, I think for the issuers facing sustained outflows will experience fee revenue compression, right? No one's going to pay for this. No one's going to pay these expense ratios for them to lose money, right? Product rationalization and closures of subscale single stock vehicles are highly likely, meaning they're just going to be gone. Liquidated, closed out. Remember I talked about, I think it was Rex, right? Rex pretty much got liquidated. For us investors, shrinking assets under management translate to lower absolute option nominal exposure capabilities, right? The most basic one, popular one is the bid ask. The higher you know, it is the more profit they have to generate, the harder it takes, the more pressure they have. And then for the category as a whole, I'm saying what I mentioned previously, that capital is consolidating, right? We are transitioning from retail extreme yield experimentation to a more smart money, institutionally optimized structure, saying, hey, look, funds like JPMorgan, Goldman Sachs, Neos, Amplify, they actually know what the heck they're doing, and they actually care about their shareholders, about their investors. They care about their branding. They care about making money. All right. So my final take, right? I exited Roundhill, as you know. Did I make the right move? Recently, you know, I've made a video about this, that I fully exited my Roundhill positions. I'm gonna give you the good. Look, Roundhill right now is still a solid issuer, right? Their thematic ETFs like MAGs are crushing it. However, the ugly like WPAY suffered a 15% capital flight, and XDTE, RDTE estimate 100% rock distribution. Not necessarily bad. I'm not hating on that, but if they're not proving that they can actually make money, then that is a problem. Okay, that pretty much, right, exiting high friction 0-day time expiration income side of the Roundhill aligns perfectly with smart money flows. That's the point I'm trying to make, right? I made a data-driven choice to preserve my principal, right? I exited Maggie because of how they were pretty much making too much ETF, not because they were, you know, a bad issuer. They were turning and giving me ideas that they might be turning to YieldMax, but as of right now, I think they're still pretty solid. If they change their management, not change the management, but if their management style does change and they stop putting out so much ETFs, right? In the future, who knows? I might go back into one of their ETFs. But as of right now, I exited. There's the good, there's the bad. I exited for my reasons. Some other people might exit it for certain reasons I mentioned in this video, right? I did mention a lot, right? So I exited Maggie because I didn't like the way Roundhill was pushing out too many ETFs. That was my decision. So if you found this informative, creative, you got something out of it, please leave me a subscribe. Give me a subscribe, comment, like, and let me know in the comments where you are rotating your capital. I know there was a few people mentioning about exiting too. You probably done it before me, but that's my call to action, is to give me some insights on where you're putting your money. Again, you make me a better investor, and I really appreciate all of you guys. I truly mean that. I want to leave on all of the comments, replying that you guys make me a better investor, and I really am thankful for that. So as you make me a better investor, hopefully I make you a better investor. So thanks for watching. Stay tuned. Catch you guys on the next.